Hey, well, hello everyone, and happy Tuesday. I hope everyone had a good weekend and hopefully stayed warm. I know it's been absolutely frigid throughout most of the country. But I just want to thank everyone for hopping on. This is, well, first of all, my name is Luke Robinson, and I am a business advisor here at Collective. And Collective, essentially, you can think of us as kind of like an all in one solution for a small business owner. We would form your business. So we'd set up an LLC for you, make an S corp election, and then handle your payroll, your bookkeeping, any sort of tax consultations throughout the year, and your business tax filing at the end of the year. So we pretty much do it all for your business. But today, I am running a little session that we like to call Tax Tuesday. And essentially, what it is it's an AMA. It's an ask me anything surrounding small business taxes, or maybe even a little bit more expanded than small business taxes. Like anything tax wise under the sun, feel please feel free to ask me, and I'll do my best to answer it. But before I go a little forward, let me get rid of the legal stuff real quick. You should consider this simply as informational sort of material. This isn't official tax advice. Like I can't see, your personal situation. I can't see a lot of your details. So it's very possible that some of the suggestions and advice I give could be wrong for you in your sort of personal situation. So don't do anything official until you speak to a tax attorney or a CPA or an enrolled agent, anything like that. Like I'm not, I'm not your official representative or anything like that. So I can't give you any sort of official tax advice. So just keep that in mind as we go through this conversation here. But I believe that we already have some questions that are rolling in. So let me get started on it. Oh, here's a great question. A lot of people are worried about this because of the 1099 deadline that's coming up here in a day. The question is, I haven't sent out 1099s yet. What can I do before the 31st? Well, what you would want to do before the 31st is to get your 1099 contractors information, their personal information. So when you hire a contractor, um, when you hire a contractor, what you're supposed to do is you're supposed to get a W-9 form back from them, back from whoever you're paying as a contractor. And on that W-9 form, the contractor will list their personal information, their LLC name, their business name if they have a business set up, their EIN number, or their social security number if they don't have any EIN number, things like that. So what they'll do is that gives you information in order to file your 1099s because you need that information in order to properly file 1099s to the government. So you get that, and then you simply just file the 1099s. You follow the 1099 form, you add in their personal information, you add in how much they've been spending or how much you've spent on them as a contractor payment, and then you send it off to the government. You can either mail that to the IRS or you can do it online, which I would recommend. And there's a lot of good online services that will file these 1099s for you electronically. So you do that. And then you need to send a copy to the IRS. And you also need to send a copy to the contractor that you're paying. Both of them you need to send copies to. So, and you've got until January 1st to do that. I mean, you've got, literally one more day. So it's important to do that. Ooh, here's a good question. Do you think the tax code will change at all in the future? Like 100 to 200 years? Interesting. Well, certainly. I certainly think it'll change. It already has changed just in the past, few decades. With the most recently with the Trump administration, like what they did was they increased the standard deduction for families. They got rid of the personal exemption, which was another sort of certain amount of money that you could write off, and they increased they increased the standard deduction. So that's one thing. Another thing is, I mean, anything could happen in 1 to 200 years. I mean, they could literally, they could, because right now the U.S. we have a progressive tax code system, which means that the more money you make, the more you're taxed on. Just kind of your marginal tax rates go up the more money you make. But we might go to a flat tax system, to where it's not marginal rates. You just have money that's just flat, that's taxed at a flat rate. So that could be it. There's several things that could change in the next 100 years with taxes. My contractors drive a lot for their job. How can I write off their miles? Well, if they're the ones driving, so this is how it usually happens. So this is how it'll work. If they're contractors, they're self-employed themselves. So they need to handle their own write-off. So like for example, let's say that you pay someone 1090 a 1099 contractor $100,000 during the year, and they drive a lot for the job or whatnot. It's their responsibility to write off those mileage and like transportation costs from their $100,000. The only way that you can write it off is if you're reimbursing that contractor for how many miles they drove. So, like for example, let's say that you're paying someone 100 grand, but the contractor, which is a write off for you, like if you're paying a contractor $100,000, you can write off that $100,000. But let's say that you're also reimbursing mileage for your contractors, like they drive a lot for their job. So how can I write off their miles? They would just need to report to you how many miles they've driven, and you would reimburse them. You'd give them another payment, on top of that 100 grand. And that would also be a write off to you. Like your reimbursements to your contractors for their mileage expenses is a write off to you. So that's how you do it. What are your thoughts on taxes for a live streamer? How much of my gaming can I write off? This is a very good question, and it's a little bit complicated because it's kind of a mix between business and personal, right? Like if you're a gamer and you're doing it for like and you're live streaming your games and making money off that, I guarantee you're probably playing that game while you're not live streaming too. Like you're probably doing it personally. Like you're not just using that gaming system for business. So it's a little bit of a gray area, to be honest with you. You gotta you gotta figure out how much am I playing this game or this system for personal reasons, and how much am I playing this game for business reasons. And you've got to come up with a ratio that you could justify, that you could prove. Like you could say, okay, well, 70% of the time I'm playing this, for business purposes and for my live streaming, and 30% of the time I'm chilling and cracking open a cold Dr. Pepper and playing some Halo by myself just to relax. So in that point, like in a situation like that, you could write off 70% of the game, of the cost it takes to, maintain the system or buy the system. I would say around 70% if you thought that you were playing it 70% of the time for business. So it's a gray area. I'm currently in school learning a trade. I bought a car to bring me to and from classes, but I also have an apprenticeship. Can I write off anything towards my classes or car purchase? You can't write anything off before you're now. It depends on how you're paid with that apprenticeship, or if you're even paid at all. For that apprenticeship, if you're paid as a W-2 employee, like if they're employing you that as a W-2 employee, you can't write off anything. Not your car, not your classes, or anything like that. But if you're a 1099 contractor from this apprenticeship, you can write off the mileage of whatever that's directly related to your apprenticeship, only if you're 1099 and self-employed. But you still can't write off any of your classes. Like the initial sort of class and education that you take, like getting a degree, or when you're actually in school to get a degree, even if you plan to use it for self-employed purposes in the future, you can't write that off. You can't write any of that off. Now you can write off, like let's say that you get in your career and you start making money and you continue your education. like you take continuing education classes or online courses or things like that, like after you started the business, those sorts of things that you can write off. But right now, as far as I can see, you can't write off much of anything, unfortunately. How exactly do home office deductions work? That's a great question. So the home office deduction is essentially, it's a way to write off a portion of your personal expenses that aren't related, I'm sorry, that are partly related to your business. So like, for example, with the home office deduction, it implies that you work from home. So you can write off a portion of your mortgage interest if you have a mortgage, a portion of your rent, your utility bill, your cell phone bill, things like that. So how you would do it is you've got to learn, you've got to find out two things. You've got to measure two things. The first thing you measure is the total square footage of your house, or the total square footage of whatever dwelling you're in, like an apartment, a house, or whatever. You get that total square footage. Then you record the total square footage of your business area, the area of your home that you use for business. So like the area of a home office or a studio or just, whatever area of the house that you use for business, you also record those square footage of that. And you take your business square footage and you divide it by your total square footage and you get a percentage rate. So let's say that, the total size of your house or your apartment or whatever, let's assume that's 3,000 square foot. And let's also assume that the business use of your home, or like the business area of your home, is 1,000 square foot. So essentially what that would be is you would do 1,000 and you divide it by 3,000. So that gives you, what is that? That's 33.333%. So what you do is you take that 33 percentage rate and you multiply it by all these personal expenses. You multiply it by your mortgage interest, by your cell phone bill, things like that. So let's say your cell phone bill is $100 and your percentage there is 30%. So you take $100 times 30%, that gives you $30 or 33%, whatever it was. And you can write off that $33 as a business expense. So that's how the home office deduction works. Okay. What's the best way to find all of my deductions? Can I just look through my bank transactions? Well, yes, like that's the place to start, is to go through and comb through your bank transactions and see which ones were for business and like which transactions were for personal. But the best way to find all your deductions, to be honest with you, is to keep your personal banking and business banking completely separate. So even if you have to set up separate personal returns, for things like that. So like, or I'm sorry, separate personal accounts for business use. So let's say that you're a sole proprietorship. Literally just go and set up another personal checking account and keep all of your business stuff in that account and all of that, because it just makes it a lot easier for tax and bookkeeping purposes when it's all in one spot. Because if you have a business account, you can just reasonably assume that all of those transactions are business transactions, are allowable for business. So that's what I would do. But if you haven't done that, just go comb through your personal bank accounts and just highlight which ones are business expenses. Okay, let me look at the question box here. Is it true that if you pay an independent contractor less than 600, do I have to issue them a 1099? No, usually if you paid a contractor less than 600, then usually there's no 1099 requirement. However, you're still supposed to you're still supposed to write that off and as an expense because you've paid them, regardless if you send out a 1099 or not, and they're supposed to claim that as income. below that 600. But no, generally you're not required to send out a 1099 if you paid someone less than $600. As an as an LLC single member, can I write off my life insurance and my wife's life insurance? No, probably not. A life insurance, it just kind of depends, with these things, but probably not. Life insurance is usually a personal purchase to where it's for personal, like it's just like for a personal event, like a personal, death or things like that. It's usually not a business expense. Now there's certain ways, like for example, there's certain ways to write off your health insurance for the business and things like that. But life insurance, that's a little bit different. Now, it might be possible in certain aspects, like if you had a certain business structure and your business was providing life insurance, so it might be possible in certain aspects. But just based on my experience, I would generally, I'd probably say no overall. All right, no problem, James. Thanks for your question. Can I write off travel for personal development retreats? Ooh, not usually not personal development. No. No, this one's a little bit more. This one's a little bit more gray. Now, can you write off travel for business development retreats? Definitely. Like if there's some sort of business development retreat that you're going to, like, or some sort of conference or whatnot, sure, you can write that off. But for personal development, it's a little bit gray because it's personal development. Like it's personal. So like if the IRS saw that, they would be like, well, you need to spend personal money to do that, and it's typically probably not a business write-off. No. If I have two companies, can the monthly fee cover both books? Okay, well, Jonathan asked, if you have two companies, would collective's monthly fee cover both books? It depends on what you mean by two companies. If you have two separate LLCs that need S corp elections, no, you would need to have two collective memberships, like for each one of them. Now, let's say that you have one LLC, but you have different DBA names for your companies. So let's say that you have one LLC that's called, Jonathan LLC, and then you have, one income stream that is a DBA of Jonathan Consulting, and another one is Jonathan Creations, like Jonathan Online Creations. If both of those income sources are going under one LLC, then yes, one monthly fee could cover that entity. You'd only have one. It's only when you have two separate LLCs that you would need two collective memberships to handle those. How do IRS contributions fit into taxes? Well, it depends on what you mean by contributions. If you're talking about retirement contributions, it depends on what kind of retirement account that you're talking about. So for one, let's say that you have a Roth IRA. Like there's these things called Roth retirement accounts. What that does is you actually contribute after tax dollars. So it's money that you've already been taxed on that you put into a Roth account, and your earnings and growth grows tax free. So like when you go to retirement or whatever and you start withdrawing money, you don't pay any taxes on those earnings or the money that you withdraw. The Roth covers that. Now, if you're going for like a 401k or like, a traditional 401k or traditional IRA or solo 401k, then you contribute to pre-tax dollars, meaning the money that you put into these accounts will lower your taxable income for that tax year. However, though, when you start withdrawing money at retirement, you'll pay taxes on the money that you withdraw. It allows you to defer taxes, is essentially what it does. It reduces your current tax bill, and it allows you to defer taxes until you start receiving withdrawals from it. I invested in the S&P 500, but recently had to take out a lot of that money for emergencies. Will I be taxed on this? Well, it kind of depends. Now, I'm sorry here. I've got to do something on my computer here. Um, it depends. So for one, if you've just invested in the S&P 500, like if there's just if you've just bought stock like ETFs or stock like from the S&P 500, then there's no penalties. Like there's no tax. Like you can sell the S&P, you can sell those things anytime you wanted to. Like there's no penalties per se. But yes, if you've purchased the S&P 500 shares, like in ETFs or whatever you're talking about, through a retirement account, then yes, there might be some penalties that you'll have to take out. But there's also like from an IRA specifically, there's some things that you can withdraw from penalty free. So, for example, let's say that you're withdrawing some money for a first time home purchase or a first time home um, or like a first time home purchase essentially. You can withdraw up to 10 grand sort of penalty free to do that. So that's one thing. So let's say that you've got some unreimbursed medical expenses, then you can do that. So and also let's say that let's say the IRS levies this account because you owe some back taxes. It's not usually subject to the 10% penalty. So there's certain things that can be withdrawn from the account that are penalty free, but it just kind of depends on your situation. Now, with a Roth account, the money that you've contributed, like just what you've put in, you can take those amounts out of a Roth account anytime you want to. There's no penalty because it's just money. It's already been taxed. It's just money that you put in there. You can put it out all the time. The only thing that you can't withdraw without a penalty are your earnings, are your gains in that Roth account. Because then, like the entire reason for a Roth is to not be taxed on your gains if you leave them in there after a certain time. But if you take them out, your gains specifically, not your original contributions, those you can take out whenever you want. But your gains you can't take out until a certain age, and you would be penalized if you took them out. Okay. Could you explain an S corp a little more? Of course I could. I work for a company who specializes in S corps. Like Collective is an S corp company. And essentially, there's a lot of people that kind of have like I guess I would say like a misrepresentation about what an S corp actually is. An S corp is not a business entity. Like it's not a corporation, sort of, contrary to what a lot of people believe. It's not. It is a tax election. So it's a way to sort of ask the government to be taxed a certain way. So for example, before you become an S corp, like let's say that you're an LLC or you're a sole proprietorship, like you haven't made any sort of S corp election. Essentially, all of your money is subject to the self-employment tax. So let's say that in the self-employment tax, it's a flat tax rate of 15.3%. So let's say that you make 100,000, but and let's say that like before you become an S corp, let's say like you're trying to calculate your self-employment tax. Essentially, what you would do is if you take 100,000 and you'd multiply it by 15.3%, like all of your money is subject to it. But when you make an S corp election, and again, that is a tax election. Like what you would do is you'd form an LLC with your state of residence first. You'd register an LLC, and then you'd make an S corp tax election with the IRS, with the feds. And essentially, what that does is it creates kind of like an employee-employer relationship between you and your own business. Essentially, like you're still the owner. But for tax purposes, you literally become an employee. And since you're an employee, your business will pay you a wage. it'll pay you a salary like just like you'd receive if you work for someone else as a W-2 employee. But the cool thing about S corps is that the only chunk of your earnings that's subject to the self-employment tax is whatever you choose to pay yourself in W-2 salary. So, for example, let's say that someone makes 100K, and for whatever reason, a for whatever reason, a reasonable salary for that person is 30 grand. Let's just assume that that first 30 grand is still subject to the self-employment tax. You still pay it. But the other 70 grand, those are considered distributions on your behalf. Another way, some people call distribution, like conceptually speaking, you can kind of think of them as dividends almost. That's another term that people call them. But that with an S corp, that chunk of money is no longer subject to the self-employment tax at all. So how do you come up with your tax savings in a situation like that? Is you'd take 70 grand and you'd multiply it by 15.3%, the self-employment tax rate. And that comes out to $10,710. So, that's over 10% of someone's net income that you just right there saving in taxes from the S corp tax election. So it can be a big difference for a small business owner making a certain amount of money. Now, there's a lot of people that think, okay, well, what happens to those distributions? What happens to these dividends? Like, can I still access that money? And of course you can. With an S corp, you can kind of think of your earning in two buckets. In one bucket, you'll have your W-2 salary, whatever amount that is. And that will flow from your business bank account into your personal bank account, just like a check would, like through our payroll processor, like through Collective's payroll processor. So like weekly, monthly, bi-weekly, like whatever's most convenient for you, we can structure it that way. Your second bucket of earnings are your distributions. And how you take a distribution is you manually transfer money from your business bank account to your personal bank account. You're done. You've taken a distribution. So you can do that at any time for any reason, however you want to. So there's that. You have access to your money at all times. All right. I think I have time for just a couple more questions here before I have to hop off. All righty. Okay. Is this recorded to watch later? Yes, it should be. If you go to our just our Instagram, our homepage on our Instagram, it should be a recorded post after I'm done with this call. So yeah, you should be able to catch it later. Ooh, here's a good question. Hi, what rate are distributions taxed at? Excellent question. So really, there's two main tax rates that you kind of have to deal with when you're a U.S. citizen. Essentially, you've got the self-employment tax, which is 15.3%. It's a flat tax rate, but you also have the income tax. So that's in addition to, that's completely it's a separate tax rate. Before you become an S corp, all of your money is subject to the income tax and the self-employment tax. Your distributions, they're no longer subject to the self-employment tax, but they're still subject to the income tax rates. Your income tax doesn't change between an LLC from an S corp. If I could get people out of income taxes, then I would be a very rich man at this point in my life. But no such luck. It's really hard to get out of income taxes. All right, real quick. I've got time for one more question. I'm a single member LLC. Should I be switching to an S corp if I recorded more than 100K this year? Probably. Now, it kind of depends. Like, we need to go through your situation a little bit more, but schedule a call with us. Like, go to collective.com, schedule a call that way, reach out to us on Instagram. Like, we'd love to go through your situation and see if an S corp would even be right for you. But that's all the time I've got left. Unfortunately, I've actually got a call with a prospective collective member that I've got to get to. But I enjoyed it as I do every week. I hope you guys all have a great week, and good luck with your businesses.